When a sovereign wealth fund or corporate treasury wants to acquire 00 million in Bitcoin, buying that position directly on a public exchange like Coinbase or Binance would move the market significantly, potentially costing tens of millions in unfavorable price impact before the order is complete. The institutional solution is the over-the-counter market, a network of professional dealers who quote prices for large blocks and execute trades directly with institutional counterparties away from exchange order books. Crypto OTC markets have developed rapidly since 2017, driven by institutional demand for execution that does not disturb visible market prices. Firms including Galaxy Digital, Cumberland, DRW, Jump Trading, B2C2, and several prime brokerage desks at traditional banks now offer institutional-grade OTC services for Bitcoin, Ethereum, and select altcoins. These desks provide price quotes for trades ranging from million to 00 million or more, with settlement in hours rather than the real-time but limited liquidity of spot exchanges. For institutions building digital asset trading capabilities, understanding the OTC market structure, evaluating counterparty credit risk, and negotiating appropriate pricing is essential operational knowledge. This analysis provides the institutional framework. The request for quote process in crypto OTC markets resembles the institutional bond trading process more than equity markets. There is no central order book. Instead, institutions build relationships with multiple OTC desks and request competitive quotes when they need to execute large trades. The quality of these relationships, and the institution's reputation as a consistent, credit-worthy counterparty, directly affects the quality of pricing it receives. OTC desk pricing for large Bitcoin blocks incorporates several cost components beyond the current spot price. The execution cost reflects the OTC desk's estimate of its market impact when it hedges the trade on public exchanges. The inventory carrying cost reflects the risk premium for holding a Bitcoin position during the settlement period. The credit premium reflects the counterparty credit risk of the specific institutional client. Spreads for large block trades typically range from 5 to 30 basis points above mid-market, compared to 1 to 3 basis points for professional equity block trading. Settlement mechanics in crypto OTC trades are more varied and complex than in traditional markets. Some trades settle on a delivery versus payment basis using prime broker infrastructure. Others use escrow services where the Bitcoin is held by a third party until simultaneous USD payment is confirmed. For the largest trades, institutions often use their existing prime broker relationships at firms like Coinbase Prime, BitGo, or Anchorage Digital to facilitate settlement with appropriate custody and credit risk management. The crypto OTC market has a distinct participant structure compared to traditional OTC fixed income or equity markets. Crypto-native dealers like Galaxy Digital and Cumberland, the crypto trading arm of DRW, dominate by volume, having built deep inventory management capabilities and risk systems specifically for digital asset volatility profiles. Their pricing algorithms and hedging infrastructure have been developed specifically for the 24/7, high volatility characteristics of crypto markets that generic trading systems cannot handle efficiently. Traditional bank crypto desks have grown significantly following regulatory clarity in major markets and increased institutional demand. Goldman Sachs, JP Morgan, and several European banks now operate Bitcoin and Ethereum OTC desks for their institutional clients, providing the familiar counterparty relationship and credit infrastructure that institutional compliance teams prefer. The trade-off is that bank desks typically offer less competitive pricing than specialized crypto-native dealers for the largest trades. The emergence of ETF-authorized participants as a significant OTC participant is a relatively recent development that has improved the overall quality of the institutional crypto trading ecosystem. AP firms that create and redeem Bitcoin ETF shares must source and deliver physical Bitcoin, creating a systematic, predictable demand for institutional OTC services that has attracted additional liquidity providers and improved pricing efficiency throughout the market. The FTX collapse provided the most catastrophic institutional case study in crypto OTC counterparty risk. FTX operated one of the largest OTC trading desks through its Alameda Research affiliate, and numerous institutional clients had open positions and collateral balances with FTX when it halted operations. The subsequent bankruptcy process revealed that client assets had been extensively commingled with proprietary trading positions, transforming what appeared to be secured custody positions into unsecured bankruptcy claims. For institutional OTC counterparty risk management, the FTX lesson is that financial disclosures from crypto counterparties must be verified through independent means rather than accepted at face value. Proof of reserves attestations, regular audited financial statements, and segregated custody arrangements with third-party custodians are the minimum due diligence requirements before establishing any material OTC relationship. Delivery versus payment settlement, where the Bitcoin transfer and USD payment occur simultaneously, eliminates settlement risk by ensuring that neither party has completed their obligation until both have. For large institutional trades where the settlement period between trade agreement and completion is measured in hours, DVP settlement significantly reduces the credit exposure window. While DVP settlement may be more operationally complex than standard T+1 settlement, the credit risk reduction justifies the overhead for trades above 5 to 50 million. Measuring OTC execution quality in crypto requires adapting the transaction cost analysis frameworks from traditional institutional trading to the specific characteristics of 24/7 over-the-counter crypto markets. Implementation shortfall is the most comprehensive metric. It captures the total cost of a trade relative to the idealized scenario of executing at the decision price, including spread, market impact during the execution window, and timing costs. For large institutional trades, implementation shortfall analysis over multiple executions with the same OTC desk provides the data needed to evaluate whether the desk is consistently providing competitive execution. Desks with superior inventory management, better hedging infrastructure, and deeper relationships with liquidity providers will systematically outperform on implementation shortfall, and this performance differential compounds significantly across large portfolios. The fill rate metric is less commonly tracked but practically very important. An OTC desk that consistently provides tight quotes but only executes on 60% of RFQs is less valuable than a desk with slightly wider quotes but 95% fill rates, because execution certainty has real option value for institutions that need to complete large trades within specific time windows. Building relationships with multiple OTC desks and tracking fill rates systematically identifies which counterparties can be relied upon during market stress when liquidity is most important. Market impact estimation is essential pre-trade analytics for large institutional crypto transactions. The fundamental insight is that market impact scales roughly with the square root of trade size relative to market volume. Doubling the trade size does not double the market impact, but it increases it by approximately 40%. This square root relationship has been empirically validated across most liquid asset classes, including crypto. For a Bitcoin trade representing 2% of a day's exchange volume, estimated market impact on a public exchange might be 30 to 60 basis points depending on volatility and order book depth. The same trade executed through an OTC desk might achieve market impact of 10 to 20 basis points, because the OTC desk can hedge the position more efficiently over time without revealing the full trade size to the public market at once. This market impact saving is the primary quantifiable economic benefit of OTC execution for large institutional trades. The time urgency component of market impact is particularly relevant in crypto, where prices can move rapidly on news. An institution that needs to complete a large trade within 1 hour will pay significantly more in market impact than one that can distribute the trade over 24 hours through a TWAP algorithm. For institutional trades where price certainty is more important than minimizing market impact, OTC block execution provides a definitive advantage over algorithmic exchange trading. Institutional crypto OTC trading has matured from an informal voice-brokered market into a sophisticated multi-dealer ecosystem with the infrastructure and risk management capabilities to handle multi-billion-dollar institutional allocations. The firms and processes that have survived and grown since 2017 represent a tested operational foundation for institutional execution. The investment in OTC market infrastructure, from establishing counterparty relationships and credit lines to building execution quality analytics, pays dividends that compound over time. Institutions that execute their first large Bitcoin purchases through hasty exchange purchases in response to board-approved allocation decisions typically pay far more in execution costs than those that built their OTC infrastructure in advance during periods of low urgency. The most important operational lesson is that OTC counterparty selection requires the same rigor as any other institutional counterparty relationship. Credit due diligence, segregation of assets, settlement risk management, and ongoing monitoring of counterparty financial health are not optional enhancements. They are the baseline requirements for fiduciary-grade crypto execution. The FTX collapse demonstrated definitively that institutional participants who skip these steps do so at their peril.